Good morning, everybody. Welcome to the Flow Show. Here we are, Wednesday, the 16th of July, the day after all the CPI data, and some of it this morning as well, which we're going to talk about in great detail, no doubt. Morning, Kay. How you doing?
Morning, Ryan. Yep, doing fine. Good morning, everybody. Ready for another day.
Yep, another day, another dollar, hopefully. Right, where shall we start? Let's start with a bit of data out of Japan. And we had the Tankan Index, which is closely watched by the BOJ. That came in with a slight improvement to 7.6 previously. That's in the manufacturers index. The non-manufacturers index was unchanged at plus 30. And the outlook for October, manufacturing seen up at 8 versus that 7 you can see on the screen there. Non-manufacturers expected to dip from that 30 to 27, but still looking all okay. Nothing major of note there on the negative side. Besant remarked yesterday that he's going over for the expo and not so much for trade talks. That's not going to stop the powers that be over there, because Shiba wants to have tariff talks on Friday with Mr. Besant. So we'll see whether that happens or not. Japan is still going gung-ho in trying to get a deal done over there. French PM Bayrou, he's working on a debt reduction plan, a big debt reduction plan for France. Good luck with that, with all the increased defence spending they want to put through, the same as everyone else. But here's one to stick on a post-it note on the side of your PC. He says his debt reduction plan is not expected to spark a recession. So be on watch for a recession coming pretty soon. Bank of England's man yesterday said inflation is down quite a bit, but it remains a challenge. And then we got today's CPI report, which this inflation that remains down went up more than expected. To do that. Headline CPI jumped to 3.6% from 3.4%, more than expected. The core was expected unchanged, 3.5%, also jumped 2 pips to 3.7%. Retail prices as well going higher, running now core retail at 4.3%. So it's really looking a bit sticky over there. You can see normal RPI at 4.4%, hotter than expected. Pretty much every measure that you're looking at there has gone up. And we mentioned yesterday how food prices have gone up, how the shopping had gone up. Food prices, or food inflation, was up for the third month on the trot and the highest since February last year. So I don't see any signs of this abating. Though there wasn't that much of a move in the quid, nor was there much of a move in rate expectations. We're still seeing some, or the market's still seeing some 49 basis points cuts this year, which was down from around 55, 56 pips yesterday. So we're still hovering around that 2-cut mark, shall we say, for the rest of the year. That probably, well, that may knock August out the hat for a rate cut, but then we've still got the jobs report to come.
Yeah, exactly. It was kind of what we talked about, what was mentioned. That was the risk. Bar is high on the basis of this report to for a cut of the Bank of England, but yeah, the jobs is going to be a different issue. If we get a really bad one, that could override CPI. Well, that's my view anyway. But yeah, on the basis of this one, nothing to for the Bank of England, at least to go all dovish about on rates. Not that, as you say, it has helped the quid a lot. Actually, on the contrary, it's trading smalls weaker again than before the report.
Yeah, very much so. And I want to point this out while we wait, have a quick look at the old chart, because we've had the Bank of England telling us that they expect inflation to tick up and that it'll be temporary. Okay, inflation give or take the odd move, has been trending higher for the best part of a year. Okay, yes, we're off these big high levels, but it looks like we've potentially bottomed out, and I don't see this picture changing for any real length of time. So temporary for the Bank of England may be towards the end of the year, but they're going to face a tough task to keep thinking about rate cuts if they see a weakening economy, but inflation continues to go higher. The BOE always between that rock and hard place, but it's getting even worse for them. The worst case scenario, or one of the worst case scenarios, is a weakening economy and high inflation. Leaves them wondering what they will need to do with rates. And as inflation is a big part of their mandate, then they could be forced to act on that side. Kay, do you think there's any which way that we can possibly see a rate hike from the Bank of England? I mean, what's the line for them? Inflation back above?
A rate hike. I mean, we're still what, 4.25% or 4.5%? I don't see that. No. I think this even the Fed, you know, and the Bank of England, all those who have cut or are in the process of, now they are waiting. But I think it's really the last thing they would have to do is to hike rates, because as we've been saying already a number of times, it's not because you hike rates 0.25% that you're going to bring inflation down. Yeah, the perception is rates versus inflation is the gap is going to widen or narrow depending whether the rates are above or below inflation. But no, it's really going to be a measure of really last resort. And knowing Bailey and a few at the Bank of England, I think they would really hate to have to raise rates. I don't think we're there yet, because you know what? Even if the inflation is sticky or even ticking up just a bit, they can still hide behind the fact we don't know what's going to happen or what will be the final impact of tariffs and etc. and the impact on the economy. But raising rates here and now, don't you think that would like have quite a big impact on the housing market in the UK as well?
Oh yeah, they have a big impact on everything.
Yeah,
It's not that
I
I think
don't see it happen.
it's
I
not
don't
that I
see
think
it
it will
happen.
happen tomorrow. But if inflation gets up, as I say, over 5%, that will put them in a really sticky situation. And I can see that happening. The thing is, and anyone who's been following the Flow Show or following me for enough years knows that central banks have very limited powers over inflation. It's all a bit of a catch-up game, and the UK and the Bank of England, they've never been able to control it. They have more chance of controlling the tide in the Thames than they have inflation. And yeah, they could stay on hold, but the market pressure will mount for hikes if we're seeing inflation trucking above 5% and not looking like it's coming down any which way quickly. And we've still got all these public sector pay rises to go through in the next month or two. So that's going to add some inflationary pressure. We've got these junior doctors looking for another 28%, 29%. So if another pay deal gets done for them, others are going to start throwing their hat in and striking, and then all the strike rounds and pay deals will happen all over again, which will be inflationary. Again, I'm not talking tomorrow, I'm talking over the next 3, 4, 5, 6 months that all this stuff might come through. So it's something to watch. It may not come to fruition, but it's something to watch. But I can bet you if we're seeing inflation above 5%, the market is going to be getting hawkish expectations for the Bank of England. Right, let's move on to CPI from yesterday. We had both US and Canada CPI numbers out. Now, depending on what calendars you're looking at, it went up more or less than expected. For this one, headline inflation was expected to rise to 2.6%. It came in hotter at 2.7%. The core, this is Reuters forecast. Okay, they had 3%. Bloomberg had 2.9%. Both still above last month. So you can call it a miss on one and correct on the other. Still, it was the core number up. Now, the difference with this is that the market pretty much went with a core number on this one, that it wasn't as hot as some were expecting. Initially, the dollar took a little bit of a knock on that, but that wasn't to last long, and then it came roaring back. So Trump, Powell, he's been a bit justified by his thoughts of keeping rates on hold, even though it goes against the mandate. It hasn't stopped Trump, obviously, from saying that inflation still isn't a problem and they need to cut rates. No change there. But this does keep the Fed justified in keeping rates on hold.
Yeah, absolutely. Absolutely. Well, it's exactly that. It's sticky. Powell expected it. He's got it, and but it's a global phenomenon that inflation is sticky these months, and the expectations for inflation are actually, if you look at the private or the household inflation expectations, they are not anchored, and there's a the market is, or analysts are now expecting that the August number will be even higher. So I trust that well, July is now dead for the Fed. They will meet before the next jobs report, and then we will see for September. So far, I think we cannot make too much of a judgment for September, because we still have a load of data to come in between. And again, I mean, this is just my opinion. But if the job market starts to falter, inflation can go wherever it wants, and they will still cut, I think.
Yeah, and as you can see from that chart, you compare that to the one I just showed for the UK inflation. We still are in a very shallow trend lower. Okay, we're not seeing a big trend up in inflation, and that's the difference. So this could just be a temporary blip, or this could be the start of the tariff inflation impact that everyone's been expecting. Although Fed's Logan makes a good point on that, which I'll touch upon. But it is a different situation. You know, I mean, they sailed with inflation above 3% for, you know, going on 4 years now, and only just started coming back, and now it's edging back up again. But it's not yet. I mean, could we be seeing a delayed reaction? I mean, I always say it with inflation, it doesn't happen overnight. It takes good 3 to 6 months before you start seeing price rises coming through. So is this just the start of it, Kay, and we're going to be heading higher?
There's a risk. I think there's a risk, although we have seen from companies, not all of them, but from some companies, that they are relatively dynamic to put the price hikes into place. We hear a lot of Americans, just like us, complaining about high prices, rising prices as well. So it may be that the effect of this round is going to show up a little bit faster. Sorry, which would then mean that we are going to see the August numbers for July, and then the September numbers for August really tick up. It's a high possibility, I think. Yeah.
Yeah. Cheers, mate. Feds ask why was the quid struggling on the CPI and the hot services number. The main reason being is the market isn't really paying much attention to it in terms of monetary policy, as I said, by the rate expectations moving from 56 pips to 49 pips isn't exactly a huge move. So the market has other things to concentrate on. But again, you know, should the pound have gone up because of the inflation? You could say that, but then a reason for it not going up is because on the other side, the economy isn't doing too well and the jobs market is softening. So what does the Bank of England do? Do they hike on inflation or cut on a worse economy? That's the rock and hard place there between. And I think the market is seeing them there as well. Right. Canada CPI, again, following the same theme, was expected to come in at 1.9%, which was a rise. That it did, came in as expected. Their core number came in at 2.7%, so that was above the 2.5 expected. Some of the other measures either came in there or thereabouts. Common came in unchanged 2.6, but this median went up to 3.1, and all the others were there or thereabouts. So even Canada seeing a little bit of stickiness coming in to their inflation as well after it's pulled back. That will keep the BOC sitting on their hands for a while. No real changes to rate expectations for Canada over there. And the loonie was sort of stuck, or dollar CAD was stuck between both data points in the price action, which we'll look at in a little bit. Fed's Barkin says there's more price pressures coming from tariffs, though he's not expecting price pressures to be as significant as in 2022. Fed's Collins says the economy is solid and gives the Fed time to decide the next rate move. It's time for the Fed to be actively patient with monetary policy. She's seeing some signs of a slowdown in the labour market amid a slowdown in labour supply growth. Fed's Logan says the base case supports holding rates tight, but the path to cuts remains data dependent. Says policy must remain tight for a while longer. June CPI suggests PCE inflation may rise above the 2% target, and that we need to see sustained low inflation to be convinced. And this is the important comment that we've just been talking about, firms and pricing and whether there's inflation waiting to come. Notes that many firms are waiting on a tariff resolution before raising prices. It's a bit hard to decide how much you're going to raise prices by when you don't know what the tariff levels are going to be. And that's all down to Mr. Trump. Are they going to be 15%, 30%, 50%, 25%, 14.78%? Who knows? So perhaps Kay's mentioned many businesses might be working on ways to get around having to increase prices, but there's also many firms who are waiting to see what the hit is going to be to them before they put their price up. They don't want to put price up by a certain amount now and then have to put them up again if tariffs are higher. So there is a bit of potential delay in any impact we see from tariffs. So a key point from Logan. Treasury Secretary Bessent says Trump has said many times he's not going to fire Powell. Says the Fed had a big forecast, or had big forecasting errors, and there may be one now, obviously talking about inflation. Though he did say that an independent central bank is important for policy. Now, despite him saying that Trump has said many times he's not going to fire Powell, Trump overnight, talking about this Fed renovations saga, said that those renovations sort of is a fireable offence. So this could all blow up if it's found that Powell was asleep at the wheel while someone was spending 2.5 billion doing up Fed buildings. He also said that Bessent is an option to replace Powell, but he says he likes the job he's doing as Treasury Chief. Hassett is still seemingly the leader in the Fed race. JP Morgan CEO Jamie Dimon said that the independence of the Fed is absolutely critical, which we all know. On the trade and tariff stuff, Trump was coming out with talk about farmers and not the agricultural type, the pharmaceutical type. He said we will start with low farmer tariffs and full tariffs are likely by the end of the month. Just a reminder that everything we've been agreeing or going through regarding trade deals and tariffs are on other things other than pharma. This is yet to be developed or yet to be a situation we know about. So this will be the next thing we move on to after we're done arguing about tomatoes and whatnot. The White House came out with a statement after Trump's comments about Zelensky and hitting Moscow with weapons. Said the FT misinterpreted Trump's comments. Trump also out clarifying, saying Zelensky shouldn't target Moscow. He also says it's going to be too bad if there's no deal in 50 days on the Russia front, and it could be sooner than 50 days for the Russia deadline. We know he likes to change things about and write letters and whatnot. That's where we're at for today. Any other headlines, Kay?
Nah, I don't think so. I don't think so. Yeah, a couple of articles really about those Japanese elections. We are heading into a bit of a hot weekend for Japan. If Ishiba manages to see Besant, see if Akazawa gets his chance as well to talk to him, and then running into those elections. By the way, I did look it up. It's if you read what's happening there, it's we could be in for quite a mess coming over the weekend, especially if both LDP and Komeito were who they are in the government with would both lose seats. Because as I said, I mean, some are trying to rally people around themselves, but the one party is asking for tax cuts, the other one's for loose monetary policy. So, and another one is now anti foreigners because due to the weak yen, there's too many people going to Japan and pushing prices for rent and stuff up. So. Good, yeah, I think I'm not going to have any position come Friday because it could be a real mess. We could be at I don't know 145 or 151 for any kind of reason.
Yeah. When do we get the results? Because the election's Sunday, right?
Yeah,
Is that Sunday or Monday in reality, our time?
I think we can. If I recall well, last time we have to know it's a partial. It's not the complete one. It's only half of the seats, right, of the upper house
Yeah.
that need to be elected. I think that if I recall well, our Sunday night we already had a pretty decent idea about the exit polls, and so I'm hoping that around market open on Sunday night we will have some kind of idea how bad it will have been for the LDP.
Yeah, that'd be good if we can get something before market opens, so we have a fair idea what's coming. And wait and see. Yeah, I don't know if I might try and sit on a little yen short going into that. I
Yeah.
think it'll be a surprise if it is good news. And even if it's good news, it's probably a dip to buy anyway.
Yeah, well, I mean, it depends whether they hold better. The combination for a stronger yen is that Besant says, "Oh, we're hearing good things from Japan," and then LDP all of a sudden keeps close to at least because they probably they don't have the real majority right now either, but keeps close to that 120, 125 number of seats. That would be the positive news for yen. But anything worse or Besant saying, well, okay, well noted, but not interested. That's probably going to see dollar yen trade above 100 or at 150 come Monday.
Yeah, that's something to keep an eye on as well. As always, lots of stuff to keep eyes on. Never have enough eyes. Anyway, data today, we've got some NBA data out. Just keep an eye on things there like the rates and whatnot, although this data's been a bit hit and miss of late. We get PPI data, which is going to be a bit of a follow-up to the CPI data, and it's looking to go the other way. PPI year-on-year numbers looking to come down a bit, headline down to 2.5%, core down to 2.7%. So the market is looking for a little bit of a drop year on year. So the surprise will be if it goes up or stays sticky, which wouldn't be a big shock, but compared to expectations, that might get the market thinking that CPI is going to be a bit of a problem. Later on, we've got industrial production. Just keep an eye on that. It's not been doing all that much of late. All this 0.1s, 0.0s, 0.2s, that sort of thing. up and down. Just keep an eye on the capacity utilization rate, though. That is a metric just to show how active sectors are in the manufacturing, in the industrial sector. So just keep an eye on that. Then we got a few Fed speakers popping up as well. Anything else of note today, Kay?
Tomorrow morning for us, the Aussie jobs report. Looking at where pairs are trading could be getting a bit interesting. Aussie went from well, especially the Kiwi, but Aussie as well. Was quite big going into the US CPI in our morning. Aussie was doing really well, and then came down in line with the rest of the dollars, obviously, but also on its own, it didn't do pretty well. And I think tomorrow will be relatively important for Aussie dollar if we're still hanging around this level. I would say.
Yep, and we've got, as I said, UK jobs report coming out
As well.
later, as accurate as that might be. But keep an eye on those wages numbers in particular for tomorrow morning. Right, let's have a look at what's going on in the pricing. I'm sitting here on Euro Sterling, so might as well start there. So yeah, we've had a little bit of a pullback off those highs. Been saying that this 86.90 to 87.20 area is going to be a bit of a tough one, and tough it's being proved. The dip isn't too deep though, very shallow. We're turning around the top of this zone, so it still remains pretty bullish for the last month or so. No reason to change that trend anytime soon, but looks like the dip buyers are well entrenched in this one, mate.
Yeah, I'm watching that those low 50 somewhere, call it 86, 50, 55-ish. I did reduce around 86.90 yesterday, as it was a level, and spoke about it as well, mentioned it in our room as well. It's a bit of a zone there, and ahead of those data, always best to remain a bit cautious. But yeah, for as long as that what is it, like 86, give and take 86 and a half, for as long as that holds, I think it's still looking up, unless we are going to see a worse behavior in the euro. Then it could be that this that euro sterling has ran its course, kind of. But then, yeah, sterling in itself is still not, I think, still not a currency to own right now. So that's how I trade it for the moment. I may actually, I'm going to have a look if I really need to keep this one or look at something else in sterling, because I mean, euro is also, at least for now, past its best bid period. And it's hard to explain the feeling, but it's we're also there in a wait and see mode, because we know about those spending plans. Yesterday, Beirut did more bad than good. He was saying about scrapping 2 days holiday, and we know what that means in France. That means if you take away two holidays from the French, they're probably going to go on strike for a whole week, and recover those 2 days, double or triple. So I mean, maybe, just maybe, the euro is, as I say, maybe more a wait and see right now, but it's not as big as it used to be either. So maybe, just maybe, euro sterling has run for now. We will see how it behaves if we get a bit of a test of that 50-55 in euro sterling.
Yeah, I mean, it's all looking dollar moves at the moment, because obviously euro dollar's coming off, but cable's coming off much worse at the moment. So it's keeping euro sterling pretty much contained and still on the bullish side of things. But yeah, that euro, it's coming off, but it's been on a half decent run, so you can't blame it for having a little bit of a pullback.
Oh, no.
We're not even close to the 38.2 of this leg. from May. So it's not, it's hard to say it's turned the corner, but that's got to start somewhere. I think this 115.70s area is going to be an important one. We got close to it, but I think that's going to be an important level if we get there. If we hold that maybe over the PPI, if it's another hot one, then that might give it the spring before board for a bit of a rebound. But as always, what we're trading this week is different to what we're trading last week and probably what we're going to be trading next week. So who knows where this goes? All you can do is watch the levels. Dollar CAD, as I said, that was caught between both CPI reports, both looking hot. The dollar or the US data usually outweighs what happens in Canadian data when the same data drops at the same time. We did see this push up in the dollar, obviously not to the magnitude we saw elsewhere in other pairs. We hit the zone again, and now we're just wondering what to do around this zone, whether we can get into it or break through it. What we might find at the very least is that we sort of at this 136.50, 137.10-ish range, we might just find that stepping up. I want to see if we get any dips to 136.85 and how that handles. If we get a hold there, then maybe we're just going to ping pong a bit between this zone and that level. Or if we break through it, then we could be off to the races. It's still looking constructive for a bottom, the way these levels have been holding, particularly now this 136.50, which was big enough on the way down, and we turned around it several times, and now we're holding it as support. So this is still your key level. This 136.80 could become another one. Right, okay, I'm going to bounce it over to you, mate, because I waffled on yesterday.
Okay. First of all, Derish was asking about Euro-yen. Yeah, Euro-yen. Let's have a look at that Euro-yen, and I'm going to go on a slightly wider one. On the daily, because it has done this pretty very, very strong move higher. But you see from where it started and the timing as well, because I think this is important. This is when we started really to hear about US and Japan not finding a deal. Well, we are still in the same scenario there is, right? So we are banging against highs here. Technical wise, yeah, just above 173. There's a bit of a level. We are struggling to hold the 173, but is it the euro or is it the yen this time? I'd say perhaps a bit of both. I could see this having also stabilizing more than continue to rally further, at least until the weekend. But we also saw, and that's why I went on to the daily, you see these highs here prior, a bit of a low here, a bit of a zone here. That's all going around that 78.6 of this big move lower. And we came back on it as well on Friday and then jumped from it. So I would say 170, 95, 171, the figure, give and take pips, because it's euro yen, it's can move relatively fast as well. That is going to be the first indication. If we start to get back below there, there's probably a bit more to do. And then we get a test of 170. But for as long as we don't go below here, I know it is about 1% away, but that is what Euro-yen can do in a day as well, if we get any news or so. But for as long as we're above here, I'm not going to call the end of this move, and then we will see once we get into the weekend where this thing ends up after the weekend. And dollar yen is about the same kind of picture. We're above the box now, just. It ran up to 149.20, but we're now stabilizing a bit. Yields, yes and no. Yeah, it has followed yield, but still, I still think that and we see from where again we were starting to move higher. It's a lot has to do with that uncertainty surrounding trade, and perhaps as well into the election weekend. I don't think it's going to drop much from here unless we get something that turns the dollar around, and in that case yields coming lower, and then we can have a bit of a retest of that underside of the box perhaps. But I would not expect the dollar yen to really turn around right now, but just maybe starting to pause a bit, okay, and then see where what we have to do. And I know it's only Wednesday. There's still 2.5 sessions to go. A lot can happen. It's yen. We can trade a bit volatile be a bit volatile in yen as well. But the main idea for me is that any correction is probably going to be met with buyers, and I would say already low 148s now are going to be a candidate to see those buyers step in. There's yeah, let's look at his Aussie. It's interesting, and I voluntarily kept that line going through this big spike lower in June, because the levels are showing up on as a support again along this trend line. Yesterday we came very close. We're still not miles away. This is 65.05. This is going to be interesting because we have been trading inside this channel apart from this blip lower in the Aussie. So and going into tomorrow's jobs report in Australia, it's going to be an interesting watch. That 65 the figure. If the jobs report is bad, I'd expect this to let go, and then we will have to see if 64.85 gives as well. It's going to be looking a lot more bearish than what we have seen of late. If it would break, it may start to have the looks of the Kiwi, which is a lot weaker than it's causing the Aussie right now. This is on a in a bit of a downtrend here right now, or at least a downward channel. Unless something really happens to the dollar, those support looks like they are going to be tested 59.30, and then I would say 59 around 59, stretch it to 59.90 or so. We have seen that 59.90 show up in the past as well. It's going to be an interesting test if we get there. This looks quite a bit weak, because yesterday we were trying to ahead of the US CPI, we were trying to regain 60 and hold above, but it was met with pretty strong selling. Pretty strong selling. This is stronger than what happened in the Aussie. Okay, so for the time being, Kiwi still not looking as good as the Aussie. So as you know, I always try to look at which one, if I have a position in something, which one is looking better than the other. Well, I'm still rather, if I need to have, or if I want to have a dollar short, or if I want to play something, I'd rather still do it in the Aussie than in the Kiwi. It really has to go above 60 and hold to start moving higher again. For as long as that doesn't happen, I don't I don't really like the Kiwi too much. A quick look on the metals. Interesting is that we saw that decline in gold from those resistances, but again we are holding the 33 and a quarter, and it's tried a couple of times below, but it can't break below. So we are in a range here. Sorry, 33 and a quarter, 33 three quarters. I think gold is trying to make up its mind whether it has to trade um, a bit of risk off. Um, it followed the dollar in parts, but if inflation is sticky and if inflation ticks up, this is not necessarily going to go down. Okay, I mean, it could be also a hedge against inflation, as we have seen in the past as well, on when the big recovery started. Um, yeah, I think it's still holding pretty well. The trend line is now coming to market, and as I've been saying already a number of times, I don't particularly like it. It comes in around 33.10, sorry. Could be enough, but I'd still allow for a retest of 32.85 um, before calling the end of the party in gold, and seeking for deeper corrections. So for the time being, I think a bit range here, and watch out if we start to break above 33.75 again, because I think then the next move into the 34s is on its way. Silver, I am patiently, or trying to be patient, to wait for a setback into the 37.30, 36.80 zone to start reloading again. But I'm starting to have waiting for Godot feelings, like happened here when we were waiting for 35, 34.80 to reload, and it never happened. We never came close enough to start to reload. So I'd love to see a test of this at least 37.15.30 in silver. If in turn we break back above 38.40, could have the same thing as in gold and correction over, and we're going to trade higher again. It still is very, very bullish to me for as long as it stays above 35. Just some quickies on what Ali was doing in dollar Swiss. Yeah, you were long dollar Swiss, but look, I mean, for as long as we are below 80.35, even 80.80 in the bigger scheme, this is still corrective. Okay, yes, you can play the dollar long because it's been a decent play. The dollar has come back, and Swiss actually followed this time, because Euro Swiss didn't dump when the euro came down. So it's still a decent play, but to really start reversing, we have to go through those two levels, 80.35 and 80.80. Okay, those are the two big levels. Yeah, I'm also still long dollar Swiss from already a good while ago, and I'll keep it until this until I get knocked out around 92.80 or so. This I think, wasn't it? Oh, yesterday we had a quick look below. Yeah, but my stop is really at 92.80. For as long as we are holding, I'm living on hopium, which is not a strategy, by the way, but fundamentals are still not doing well for the Swissy, and I think we should at least hold these levels. Quick look on oil. We had a monster build yesterday on the APIs, 19 million barrels, which is historically a very, very big build. Not that oil really looks too impressed by it. If you look at it this way, that blip up that we had near 70 the other day is just going to test the top end of perhaps a flag or something like that. To me, global picture, oil still not looking good, but it is holding in maybe a bit. No, this one is okay. I know a bit too many lines, but let me just do this. No, I'll do it later. For as long as we have this big zone here, the in the 64, 63s, historically down to even 61 and etc. As long as we are holding above, there is a chance that we get back above to the 70s or so, but the overall picture is still looking bleak. Any calming down on geopolitics or so, I guess we're in for a test of the low 60s again. That's how I look at it anyway. And all the serious bounces are getting sold into. That's how I look at gold right here and now. And Ryan, I think I'm sort of through, mate, for today.
Thank,
Yeah, and I gave it back to you, mate.
Thank you very much, mate. Just go back to AES and talking about the Powell and whatnot. We've had this discussion before around him and whether he can get fired or resign or whatever. The real trading implications for Powell, the Fed, or whatever, is really down to the independence question. Okay, it doesn't matter whether Powell resigns, fired, or whatever. It's what the market deems whether the Fed is going to be negatively impacted going forward. Is their independence going to be negatively impacted? Central banks, for all our love and hate of them, and when they get it right and wrong, and the Erdogans of the world who can change central bank heads anytime his tea's too cold. Institutions like the Fed, ECB, BOE, they need to be upheld in the market's mind. Any tinkering with that, any messing with that is going to get a negative market reaction. Now, whether that's more dollar selling, if that sort of comes to pass, because we've already seen the market willing to get out of US assets or reduce exposure to the US, that will become more so. In such a case, you're probably going to see yields rising, which will put financial impact on the States. Take out the politics of it all and look at what it means for the markets. And you're right, it's whether it's a real negative, which I think it will be if such a thing were to happen. And it still may happen, depends on who goes in the hot seat and then how much influence they may try and assert over the rest of them. Remember, there are 12 Fed members, active Fed members and voters and whatnot at any one time. So even the Fed head only has one vote in that scenario. So it doesn't mean they're going to get their own way. But if the market doesn't like the influence that Fed head may have on the institution, that's when it's going to start getting worried. But anyway, that's something to look at over the months ahead. Right, thank you very much, everybody. Hope you have a great day. Thanks for coming to the Flow Show, and we'll see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.